do is say, this is not a political speech, so please no political comments. So whether you like the tax, don't like the tax, feel that you shouldn't be paying it, or who pays it, or how much you pay, please save that for yourself or on your own time. But as I go through this, I would prefer to get through all of it before answering questions, but I think the easiest thing to do is, so you don't forget your question, you can put it into chat. So go ahead and do that if you have questions along the way on something I mentioned, and we'll have plenty of time at the end for Q&A, but I'd like to get through some of the definitions first, and then we can get to questions and answers after that. So the first thing I want to talk about is the corporate activities tax, or as I will call it, just a CAT. It's also called CAT tax, but that's sort of taxed twice. So we try not to say that. So it was passed to raise substantial funds for public education in Oregon, enacted the CAT tax in 2019 with House Bill 3427. The Oregon CAT is a separate tax and may be imposed regardless of any Oregon income or excise taxes. On May 16, 2019, House Bill 3427 was signed into law. In addition to the CAT, HB 3427 also contains a variety of educational provisions, and the Oregon CAT is anticipated to raise approximately $1 billion in new annual revenue to state investments in education annually. They're estimating this year it could be down from that because of COVID. So despite being called a corporate activities tax, the new gross receipts tax applies to virtually all forms of business, including C and S corporations, individuals, joint ventures, partnerships, trusts, estates, entities as disregarded for federal income tax purposes, such as certain limited liability companies. The new tax will be imposed on sellers, not purchases. It joins the state's personal income tax, corporate net income tax, and gross receipts-based minimum tax. The tax applies to businesses in every industry, including insurance companies and financial institutions, unless they are excluded persons, a term that covers governmental entities, as well as certain nonprofits, hospitals, and long-term care facilities. The CAT is imposed on persons who have taxable commercial activity exceeding the threshold and substantial nexus within Oregon. Substantial nexus means they either have property, equipment, or payroll of greater than $50,000 in Oregon. To determine the applicable tax, a person must first calculate its Oregon source commercial activity and then the allowed deduction based on certain costs. The net is the taxpayer's taxable commercial activity. Any taxpayer who has nexus with Oregon and whose commercial activity exceeds $750,000 must register with the Oregon Department of Revenue within 30 days of reaching that volume. However, no tax is due until a taxpayer exceeds the threshold of $1 million in taxable commercial activity. CAT is imposed at 0.57% of taxable commercial activity in excess of the $1 million, plus a flat tax of $250. The tax is imposed on the person with the taxable commercial activity. Taxable commercial activity, CAT is imposed on gross receipts sourced to Oregon, net the applicable deduction, referred to as the taxable commercial activity. Taxable commercial activity is defined as the total amount realized by the taxpayer arising from transactions and the activity in the regular course of taxpayer's trade or business that are sourced to Oregon, net the applicable deductions. Oregon excludes numerous specific items from definitions of commercial activity, including but not limited to the sale of groceries, receipts from the sale, exchange, or other disposition of business assets, certain interest income, contributions to capital, sales of motor fuel, dividends received, sales to Oregon wholesalers who certify that the property will be resold outside of Oregon, intercompany transaction among members of a unitary group, and distributive income received from a pass-through entity. Subtractions from the gross receipts A taxpayer subject to CAT is allowed a subtraction of 35% of the greater of the taxpayer's annual cost input or labor cost against Oregon source commercial activity. Cost inputs are defined as the cost of goods sold as calculated in arriving at federal taxable income under the Internal Revenue Code, while labor cost is defined as total compensation of all employees. Labor costs include most types of compensation paid to employees, such as wages, health insurance benefits, retirement benefits, and any other fringe benefits, but does not include the employee's payroll taxes or compensation in excess of $500,000 paid to any single employee. The subtraction must be apportioned to Oregon in the manner required for apportionment of income. In addition, the subtraction from commercial activity cannot exceed 95% of the taxpayer's commercial activity in Oregon. A unitary filing. A unitary filing is a combined filing that's required for businesses that are unitary and have more than 50% of common ownership. Entities that meet the ownership threshold are deemed to be unitary if there is an exchange or value demonstrated by either centralized management or common executive force, or centralized administrative services or functions resulting in economies of scales, or a flow of capital goods, capital resources, or services demonstrating functional integration. Members of a unitary group may be in the same general line of business, such as manufacturing, wholesaling, or retailing, or members may be in multiple lines of business that constitute steps in vertically integrating process, such as the steps involved in production of natural resources that might include exploration, mining, refining, and marketing. Unitary groups must register, file, and pay as a single taxpayer. So basically, you can't have two different businesses that have $600,000 in sales and own both of them and say that, well, each of them are under the $1 million and they're under the 750, so I don't have to register it. Since you own more than 50% of each, you'd have to combine them and file it together because you'd be at 1.2 million in sales. The tax filings for this, the CAT is a calendar basis tax, no matter what accounting year the taxpayer has. Tax returns are due on April 15th of the following year. An extension for filing a return is allowed under the statute. The Department of Revenue is looking to provide a 6-month extension, but they haven't decided on the final time period yet. Taxpayers are required to file quarterly estimated tax payments if the total tax due is estimated to be $5,000 or more for the year. Due to COVID-19, for 2020 only, this amount has been increased to $10,000. If funds are unavailable for quarterly estimated payments due to COVID-19, waivers may be extended for abatement of penalties and interest if a business can retain and show documentation that they were affected by COVID-19. Quarterly estimated payments are due on April 30th, July 31st, October 31st, and January 31st of each year. So in the next 2 days, the first quarterly estimates are due if you feel that your tax for the year will be more than $10,000 in this year only. So a few miscellaneous items. You were sent a link inside the invite. And so I'm going to share the screen of that link. And it is the corporate activities tax on the Oregon Department of Revenue's website. And this is a great site that at least explains quite a bit. And they update this site almost daily with something new. But it explains a little bit about the tax. Once you hit $750,000 in sales within 30 days, you have to register. You can do that right here. And so along with that, the next best things on here are frequently asked questions, which are in this blue area below here. I always go to this one, which is beyond the frequently asked questions, because that's more of the technical questions. It gets some of the definitions of how we can calculate the 35% deduction. And then the other good thing on here that I did way back, probably in October, was subscribe to the CAT mailing list. So if you actually put your name and information down here, they will send you updates as they change rules or put proposed rules out there. currently all the rules are proposed. There's nothing final. So there's a few out there right now in the period where they're asking for comments and they can actually be changed. They're still writing new rules. They don't have all the rules for this tax. So even though the tax was enacted as of January 1st, the first quarterly estimates are due this week, they're still writing the rules for this, since the actual return won't be due until April 15th of next year. So the hard part is for people to estimate what the tax will be when they're still writing the rules along the way. So I think in year 2 and 3, it's going to be a lot easier. But if you mix the COVID-19 issues along with no rules, no actual tax form for people to use, no instructions or definitions yet, it's going to be a difficult year projecting what your tax will be, although there is some worksheets out there inside of this that you can do to guess what it is, but until they finish all those rules, we won't know what those are until the end. So the other thing is already more than 10,000 taxpayers have already registered for the CAT. Because the new tax only applies to Oregon source income, it is important that your accounting systems and records for 2020 forward can track and provide information regarding Oregon source income of goods and services also provided to customers located outside the state. CAT is imposed on gross receipts. Entities with a net loss are still subject to the tax. The tax is deductible against federal and Oregon income tax returns. So I will unshare this. If I can, we have to admit somebody here. And then let me go back in here and stop share. I'm just learning how to do this one. So, so now if we have any questions, it looks like there's a few in chat right now. I see that, John, well, no taxes imposed until you hit $1 million estimated taxes, even if you have not yet hit the threshold, they're still due on 4/13. Yes, that is correct. So let's say that you probably won't even hit the 750,000 even to be required to register until, let's say, third quarter or fourth quarter. And if you think you're going to hit the $1 million by the end of the year, let's say you did last year, but you probably won't hit that till the fourth quarter. If you estimate you're going to owe $10,000 or more, you would be required to register and file that quarterly tax by 4/30 this year if you're estimating more than $10,000 in tax due this year only, or $5,000 in all future years. So two things about that is, even it's sort of confusing that you're supposed to register when you hit $750,000 in sales, but you actually might have to register if you have to pay quarterly tax, if you think you're going to hit it. You could be a seasonal business or something else where you actually wouldn't reach it till later in the year. But if you're going to actually owe the tax, you have to pay a quarter of that now. So you would have to register early. So of those 10,000 businesses that have already registered, my guess is some of them hit $1 million in sales last year and don't want to have to figure out later on in the year when they hit the $1 million, not a big deal. If you don't register when you hit within 30 days of hitting $750,000, they will fine you $100 a day for not registering on time. So that's why a lot of people are just registering early, and they might not even hit 750 this year due to COVID or something else. And there's no tax imposed until you reach that $1 million in sales. So even though if you register early, then it still gets it out of the way. You don't have to worry about it. But that's the one thing. To confirm, subtractions are labor or materials, cost of goods sold, but not both. Right. Correct. You can have either or both. Within cost of goods sold, you can have some labor, though. So that's where it gets a little confusing. The hard part of this is cost of goods sold is only allowed for basically manufacturing businesses. A service type business might consider themselves to have cost of goods sold, but you pretty much have to be a business that's manufacturing or creating inventory. I don't want to get too far into the weeds, but you have to have what's considered 297A, which is absorption inventory costing, where you're including your overhead and other items in your inventory, freight in but not freight out. It also includes anything under the definition of cost of goods sold under the Internal Revenue Code, Section 471. So it's not just TIR's definition of cost of goods sold, correct. So it has to meet Section Code 471, not just variable costs. So does anybody else have a question? We'll open it up. If you don't want to chat and just want to talk about something, we can open it up for that too.
Just so everyone knows, I did put the link in that John shared in the comments, and then also the article that he shared has been posted in the comments. So if you did not see that in your email, it's here, so you can go look for it.
The thing about that article is I read it again last night, and it's a good article. That sort of it's a local Tiger business person, so that's also why I put it in there. But that article was written in January, and in January, most of these proposed rules were not out at all. And so there's some things that are discussed in there that have been clarified since, and some things that were discussed in there that don't make sense when you read them now, assuming you know the new rules now. So the interview probably would have been a little different, but I actually thought it was a good article because it was a Tiger local business. So.
Hey, John.
Yep.
Good morning. Thank you for doing this.
Good
There's
morning.
so many questions surrounding this for businesses. Can you talk just a little bit about construction? What kind of stuff is excluded on construction? Is it still, so I'll give you an example. I have a client I'm talking with today who they do 15 to 20 million a year, and they are in gross. They barely break even, unfortunately, and they're trying to figure out what they're going to have to do. So is this the, does all of their, they sub everything out, does all of their cost for the homes, is that a subtraction?
The cost for the homes is, and that's where, if you read the article that I sent along also, that was a home builder.
Okay.
And so that's where that comes in. And so Jeff Bettinelli is a local home builder. I used to work with him in a CPA firm. And so from that standpoint, he's a CPA that's now a home builder. So contacting him, and if you need to, is also helpful because I'm sure he's gotten a lot into it also. And you could use my name if you need to contact him. So, but from that standpoint, it is the cost of the home is included, and that's part of the cost of goods sold. The hard part is you say subcontractors. When you're doing a inventory item such as a home, it would be considered subcontractors are included in that cost.
Yeah.
When you're considering service business and you hire a subcontractor, those are not considered wages under the definition. So you have to be careful of, you can use one or the other, but the definitions for both are very different.
Thank you, that's perfect. And I'll read that article, I appreciate that.